Welcome to Money Mavericks and Mayhem, the podcast where finance meets audacity in a whirlwind of insight and excitement. Join hosts Adri Blyer and Ryan Duchak as they bring you closer to the stories of risk takers, rule breakers, and boundary pushers who are reshaping the financial landscape. Perfect for seasoned investors, budding entrepreneurs, or anyone curious about the tumultuous world of money. This is Money Mavericks and Mayhem.
Welcome back to Money Mavericks and Mayhem, where we dive into the lives of financial mavericks, learn invaluable lessons in personal finance, and uncover the scandals that shook the financial world. I'm your host, Ryan Duchak, here with my co-host, Adri.
Hi, everyone. Today we've got an exciting episode lined up. We'll start with an interview about Jim Rogers, then move on to understanding the difference between a bear and bull market, and wrap up with the story of the Tulip Bulb Market Bubble. Let's just dive in and get started. All right, so Ryan, as we said, today we're talking about Jim Rogers, who's a legendary investor known for his adventurous spirit and investment acumen. Can you tell us a little bit about his background and what makes him a financial maverick?
Absolutely, Adri. Jim Rogers, not to be confused with Fred Rogers, who had an adventurous spirit as well.
Or Buck Rogers.
What's that?
Or Buck Rogers.
Buck Rogers, too. Yeah, there's
That's
some
a good
good
one.
Rogers out there.
All the Rogers are pretty adventurous.
Yeah.
I'm sure there's a bunch more.
Now, Jim, instead of being a Pittsburgh guy, he was born in 1942 in Alabama. He started his financial career on Wall Street after graduating from Yale University and later attending Balliol College at the University of Oxford. Now, in 1970, he co-founded the Quantum Fund with none other than George Soros.
Dun, dun, dun. I mean, today, George Soros, he's his reputation in the investment world is fantastic, but kind of globally, perhaps
Controversial.
little bit controversial. But nonetheless, from Jim Rogers' perspective, it's really impressive. What did he do after?
Well, he left the Quantum Fund in 1980, and at that point, Rogers embarked on a series of global investment adventures, I think is the best way to put it. He's perhaps best known for his around-the-world trips, first by motorcycle in the early 1990s and later by car in the late 1990s. Now, these journeys were not just for thrill-seeking, though. They were also opportunities to research global markets firsthand.
That's amazing. I mean, that's the way to do it, right?
Yeah.
Just
Let's go
jump
on a
on a
road trip.
flight and go on a road trip around the world. And you got all the money, so you kind of rough it for a little bit, but then you're staying at the Ritz-Carlton in Paris or whatever. But that's in the 90s. And in the 90s, I don't know it's hard to gauge by the media today, but I don't really know what the outlook for Americans are with the rest of the world. I've had some friends that have traveled and they're like, no, everybody still, generally speaking, respects Americans or likes Americans, and they're not. But in 1990, in the 90s, I got to travel Europe, and it was a time where everybody loved Americans. I mean, you'd show up, everybody buys you drinks, it was really fun. We had a great time. So that seems like the best time to do something like that, just traveling the world and kind of, researching your passion at the same time. I'm jealous is what I'm trying to say. Completely
Me
jealous.
too. I mean, hear what you're saying. My fear to do that right now is American ignorance has overstayed its welcome abroad.
Yeah.
And we might not be welcomed with the open arms and buying you dinner as it was when Jim Rogers did it.
Yeah, no, I'm right there with me. My son is getting older, and he's like, well, after graduation of high school, I want to spend a few weeks over in Europe and just backpack around. And I don't know. I just don't really know, because if you look at the media, it doesn't sound great. But again, I've talked to some people that have traveled abroad, and and I think that's a wonderful experience. as a parent, get a little bit worried. But back to Jim Rogers. Jim Rogers has written some books, lots of insights, which have also made quite an impact in this space, correct?
Indeed. He authored several influential books, which included The Investment Biker and Adventure Capitalist, where he shares his experiences and investment philosophies. So he makes it less dry. I don't want to knock the pure investment philosophy books, but a lot of people find them boring in tough reads. He's talking about his road trip around the world on a motorcycle and breaking investment philosophies into that. It's a pretty good way to read an investment book, is what I'll say. And he's a strong advocate for investing in emerging markets and commodities. You learn a lot about that with his adventures. And he makes it into kind of firsthand experience that is a little bit more exciting. Now, he also has a distinct approach and willingness to go against the grain. That's kind of how he solidified his reputation as a true financial maverick. It's not just, this is how you're supposed to do all this. He bucked the trends, and I'm going to do it a little bit different. I mean, who wants to look at all the world foreign markets and says, I'm going to do it on my motorcycle or I'm going to do it in a car? That's very rare anymore.
And especially in this business, in this industry, because, a lot of people are, very analytical and don't really live their lives outside of the norm. I mean, there's not so many adventurers in the investment finance business, and it's refreshing because, to your point about books, I mean, listen, I'm interested in this. 90% of the books are so poorly written. There might be good information in them, but we've had this conversation on the show before where there's a point in time where you're learning the information and you want to project yourself as smarter than everybody. You want to be the smartest person in the room a lot of the times, especially in this, not you, but generally speaking, any kind of consultant, hopefully they go through that process and don't stick with it, where you're over talking. And a lot of the books are written that way, where they're trying to, the author seems like they're trying to make themselves seem better than the reader, instead of just breaking it down, which is more important. A lot of times I read these books, holy, I just get to the point. All right, I don't. You're making this way overcomplicated for your own ego, not for my benefit. I think Jim Rogers, it seems like he kind of understood that, or at least got past that part. Maybe he had that part in his life and was able to say, okay, let's just talk like normal people. But
Well, it's, I think in today's world, the best way to kind of relate it, for me at least, is the thought of how do you get the best picture of something that you're thinking of investing in? Boots on the ground or sitting behind your desk reading spreadsheets? And if we're in running hedge funds or fund management and doing things like that, it's really, I think you get a clearer picture of what's going on. If I'm going to look at the market, just the US market, I can turn to your point about Europe, I guess, is a better example. You can turn on the news and see what they have to say about Europe, or you can call people who are there, talk to them, and get their opinion, or you can go for yourself. You're going to have 3 differing opinions, most likely, or at least 2 differing between what the news is projecting, and part of the news's job is to create fear for viewership, versus you go to Europe or you have some friends who were in Europe last year. Well, maybe don't go to this area, but this whole other area is incredible. It's amazing, and you're welcomed with open arms. Then going and experiencing it for yourself to really get a full full breadth. I mean, to your son's point of backpacking around Europe, he doesn't need to do that to research Europe. He can open a book and learn all about it. He can surf the internet and learn all about it.
You can get on
Or
Google Maps today and then kind of do that street view. And if you spend enough time, you could pretend like you were there, but it's different being there.
It's very different. You get a much better grasp of it, to bring it back to the investment landscape, by having your feet on the ground there.
Yeah.
And really getting an understanding of what's going on.
Yeah, it's definitely important. And certainly, Jim Rogers' adventurous spirit, I guess, and investment prowess are really inspiring, at least to somebody like me who understands paralysis by analysis. And, not to say you shouldn't do any of your homework and just go out and try things, but for instance, if you're going to Europe, okay, let's read a little bit about where you want to go. Let's set some details, how you're going to travel there. But in the end, you still got to go. You got to jump on the plane. You got to jump on the train when you get there and figure it out. And I think a lot of people, they don't get a lot accomplished sometimes because they're going to feel like they never have enough education to make that move. And I think it's very important to make that move. Thanks for the insights, Ryan. And now let's move on to our next lesson segment about bear and bull markets when we come back. Endurance sports, swimming, biking, or running can be a great way to stay healthy and fit, as well as test your physical and mental strength. Having a dedicated coach provides accountability and structure for an athlete's training, ensuring that the healthy lifestyle is maintained. With their guidance and expertise, Victory Multisport coaches are able to challenge athletes to not just reach their personal goals, but dig deeper into themselves and achieve things they never thought were possible, pushing them out of their comfort zone with confidence. They will create a customized training plan and provide motivation when times get hard so you don't lose sight of the desired outcome. Victory Multisport offers tangible results that allow anyone to surpass their greatest expectations. Reach out to the coaches at Victory at info@victory-multisport.com. That's info at victory-multisport.com. Victory Multisport is not affiliated with LPL Financial or the Monteverdi Group.
And we are back. Adri, many people hear the term bear market and bull market, but might not fully understand what they mean. I mean, in my head, bears and bulls are both scary. So I would equate those to be bad. Can you break down what those two terms mean and a little more light on it?
Teddy bears are not bad, Ryan. They're very nice things. We actually talked about this not too long ago, and I still haven't really read up on the origin of bear and bull. I mean, where they specifically maybe, but because you're right. I mean, I don't want to be in front of a bear or a bull. They're terrifying. I watched this movie. Don't ever watch this, people. The Grizzly Man. I don't know. Did you see this about the grizzly bears? Don't watch it. It's like a documentary. It's terrifying. Guy lives with these bears. Obviously, he's insane, but he goes into the wilderness every year and lives with grizzly bears. He's like smacking them on the face. Giant grizzly bears. And you don't need to be a genius to figure out what happens by the end of the movie. I'm not going to spoil it, but use your imagination. But from a
you're not going to spoil that one for me. I do know the origin, the bear and bull, but I'll wait for you to give the explanation. Because it might have ruins the explanation if I tell you the origins.
So both of them really describe just the general direction of the stock market over time. When we look at a bull market, a bull market is more characterized by increase in prices, consumer optimism or investor optimism. It often corresponds with, when we're looking at economic growth and higher employment rates, increased profits or corporate profits. Investors are, it's confident. It's a confident time. People are jumping into the market. We're on an upswing. We're on that. Everybody gets excited, and there's a bit of FOMO going on. That's what we would call that kind of market. In the demand for stocks basically are increasing, which then do what? We talked about supply and demand a little while ago. That's going to drive prices.
In a bear market is the opposite.
Correct. Yeah. The bear market, or a bear market, generally speaking, again, this is very broad strokes, but occurs when prices are falling. Typically, we're looking at about 20% or more from the recent highs. In this period is marked by just the opposite, as you said, pessimism, negative investor sentiment. There are economic indicators like GDP growth, employment rates, corporate profits are often declining at this point, right? When we're looking at that kind of market. So investors become risk adverse. So they're starting to pull out of the market, or they're not investing in buying more stocks, which, supply and demand. Now that's leading to typically lower stock prices. Now, you can't just say across the board, because different stocks are meant for different things. So you might look at defensive stocks, but we can talk about that in a little bit. So that's why I wanted to say these are very broad strokes, just general market conditions. Does that make sense?
It does, and it also gives me the green light for the origin story, which, while both are scary if you were face to face with them, bulls generally attack, and when they charge forward to attack you. And when they're doing that, when a bull attacks you, it lifts its horns up. It's coming at you like it's charging and lifting its horns up is the general consensus of how that term came to light. And then when a bear is coming after you, it swipes its paws down at you, and they're known for hibernating or going to sleep, which laying down is what the market's doing that. And the thought is it comes from I think it was the 1700s. They used to chain bulls and bears and have it was a form of dog fighting.
Oh my
where
God.
dogs would attack these chained up animals and kind of see what happened. I'm not saying it was right. I'm not saying it should have been done, but it was a popular sport in, I want to say it was England, back in the 1700s, and that's the thought process of where those terms came from.
Wow, that's terrifying.
Right?
And
Yeah.
holy cow, they put dogs against bulls and bears. I mean, I don't want to see it. But I kind of want to know, like, how often the dogs want. I really don't want to know, but there's
Agreed.
intrigue there.
When I learned that, I thought the same thing. You have a chained up bull or a chained up bear, so they're limited, versus a dog that's free and can run all around. Who's going to win that? But at the same time, I really don't want to know. I don't want to see that. Like, just tell me.
And it seems like the bull doesn't have the advantage. I mean, because, okay, the bull's big, it's heavy, but it's only got its horns, right? I mean, I guess it can bite, but I don't know that. I mean, it's not like a bear. Bears got claws.
They use their horns primarily.
Bears got teeth, fangs. Bear will mess you up. I could see a bear just destroying a dog, where a bull, I feel like a dog or a pack of dogs. Is it just one dog or a pack of dogs?
I think it was just one.
Wow.
I don't know. I don't know that.
It's all awful. That's all awful. But
yeah.
All right, back to.
Well, you made an interesting comment when you said a bull can tear you down and tear you apart, and that's kind of the insinuation. And when I see videos of the running of the bulls in Spain, and I see people flying through the air more than getting torn down, once they land, they're not doing so hot, I'm sure. But
No.
from an investment standpoint, thinking of the markets, how how should an investor approach these types of market conditions?
Yeah, so let's speak generally, of course. In a bull market, investors, I don't want to say should, but might focus on growth stocks and take advantage of those rising prices. However, we do talk about this, you have to stay vigilant and pay attention and not become, because bull markets can also lead to corporate overvaluations of stocks, which becomes problematic. We talk about timing the market. We've talked about that in previous episodes, which typically, generally speaking, doesn't work so well. It can, so forth and so on. But if you're not paying attention, and a lot of people don't, the market's going up, hopefully you buy. When it's lower and it's starting to go up, but if you don't pay attention and get out at the right time, you could position yourself very poorly for an exit strategy. You just need to be cautious and be paying attention. In a bear market, conversely, the focus might shift to more defensive stocks, or maybe we're going to look at bonds, which we're doing a bond lesson today, but individual bonds or other assets that might tend to hold their value better, where you as the market's declining, you're just positioning yourself to absorb some of that. It's not necessarily, you're not necessarily trying to grow your way out of that market, but you're trying to absorb as much of that potential downflow as you can. So again, and hopefully that makes sense. But it's also an opportunity to buy quality stocks at the lower prices, right? Because as we talk about, it was high, it's coming down. That's the opportunity. Now, you never know. A lot of people wait till the down, till they think that it's the lowest it can go and try to buy. Timing, that's not really great. That's where dollar cost averaging, coming down into a lower market, can be very useful, because you're buying those stocks as they're dropping. As we reverse that market over time, you've owned these stocks for lower and lower costs. But again, it's not an easy thing just to say, well, buy here and sell here, because you need to be cautious and ensure that your plan is solid, right? Is sound. What I'm trying to say is, don't just willy-nilly listen to the media and say, okay, I should buy this stock. You should have a plan, a long-term plan to deal with these markets. Okay, where are we? What are interest rates looking at? How are we going to invest? Number one, what are your goals? Why are you investing? And how are we going to invest in this particular market to maintain your goals? And that's different for every single person out there. I'm trying to give very broad advice because I have to, or not even advice, just broad comments without giving advice, because everybody's scenario is so different. But you need to have that plan and be cautious, because as we know, investing includes risks. It includes fluctuating prices. It includes loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. That's confusing to people, but that's just the way that it is. Bond values, of course, can decline as interest rates start to rise. We're not just looking at stock markets, but we have to take the whole picture together. What are interest rates doing? What is GDP? What are we looking at globally? And how can we do our best to, I don't want to say predict, but foreshadow what the next move is?
And that's exactly what it is, because it's not like there's a sign that gets put up, bear market today or bull market today. We know when we were in a bear or bull market after the fact.
Yes.
Not before, not going into. You can kind of tell, I mean, you have a good idea during, but when you're in it, when is it going to change? When is the cycle going to rotate? And no one knows that. Was today the last day of the bull market? Should I put all of my money into the market today? And then tomorrow is the bear market beginning? That's the worst possible timing I could have had. To your point, using the indicators available to us in the research to foreshadow and say, it's looking like we're heading in the direction of a bull market. Let's position the overall portfolio towards those growth stocks or whatever it might be for that investor's goals. But it's not simply let's sell everything today and go all growth stock today. No, you can do that, but there is a ton of risk in doing that. And the same thing on the opposite side. If you think a bear market is coming, you shouldn't sell every single one of your stocks and dump into bonds. I shouldn't say dump into that. That makes it sound a little bit negative, but you need to position your total portfolio to best attempt to meet your goals based on the market conditions that might not be right. So that's why there's risk management. It's not as easy as tomorrow's a bull market. That's when it begins. Let's buy all of our stocks today. Number one, part of me wishes it would be like that. The other part of me doesn't, because I would have to find a new job. But it's not as simple as what market are we in today. Understanding the market cycles, that is essential for any investors. You need to understand that they can happen in the pros and cons of each, or work with an advisor who will help you do that and set your portfolios to the correct risk measures and allocations based on your goals. But it's just based on those market cycles. It's not as easy as that, unfortunately.
Unfortunately, it would be nice. Yeah. I mean, again, we would be out of a job, but everybody would be rich.
Yeah, I'd be rich in the bull market. I wouldn't really care if I had a podcast with that. And I don't mean that. I mean, there's still more to it than that.
Oh, for sure.
But it's also, sometimes we'll laugh where in certain market cycles, in certain times historically, in an extreme bull, for all intents and purposes, you could close your eyes, throw a dart at a dartboard full of stocks listed on it, and you're going to do well. It's not about when you're in the market, and again, after the fact. Once you realize you're in it, you could have done that. But you never know it going into it, and it's not as simple as just picking out, let's buy whatever, let's buy any stock. It's still not, it's a generalist market condition. It's not for every stock. If we're in an extreme market today, and I don't know, what's a good stock to pick on that has had some success lately? Well, look at an Apple. I know we like to pick on them a little bit. Just because we're in a bull market, it doesn't mean Apple's going to do well. If all of the sudden a new type of phone or new type of something that competes with Apple comes out and blows Apple out of the water, they're going to lose value. Mm-hmm. Even though we're in a bull market, they're not going to follow that market trend. It's just kind of not as simple as, let's buy Apple. We're in a bull market, let's buy those growth stocks. Apple's a growth stock. Yes, it is. And theoretically, it should do well in a bull market, but that's theoretically. If something happens internally with them, or they lose a distribution plan or something like that, that's bad for them, even though we're in that market. It's not every single thing goes up or every single thing goes down on the.
No, and that's where paying attention, because you could also argue sector-wise, picking on tech, and maybe tech's not the best one to pick on because they are such a large part of the market today. But if you have an issue globally, when you talk about semiconductors and we had shortage of chips, well, that affects, generally speaking, the market could be in a bull market, but you have a sector that isn't doing well for one reason or the other. So you can really pull apart the bull market and say, well, tech isn't doing well, the general market's doing well, but why isn't tech doing well? Well, because of X, Y, and Z, whatever those factors are. To your point, it's not global, but it's just the general sentiment of the global market.
Yeah, you have to understand the regulations. You have to understand everything. And I always use the oil and gas world when I look at markets like that we're in a bull market. Awesome. Should I buy oil and gas? It depends. Are we shutting down drilling? Are we banning the use of gas? Then you should not. Or are we expanding our drilling and everything's great in that sector? That's the intricacies sector amongst sector. General market, yeah. When you look at it, the average is going up. That's positive, but it doesn't mean each sector is. Let's move on. I appreciate your breakdown of those and the thoughts on that. It's complex as everything with investing. We apologize for that and not having time to really dive into all the nuances, but they're all high level things that every investor needs to be aware of at the very least and pay attention in their overall investing.
Well said. Well said. Let's move on to good segue to move on to our final segment of the day, the mayhem, the tulip bulb market bubble. Say that. I say it 10 times quick. Come on, Ryan, let's do it.
Oh, I'm good. I'll stumble through this. I'm plenty.
All right, we'll be right back.
Tulip Bulb Market Bubble.
Best Ever Granola is a woman-owned, Pittsburgh-based company specializing in small-batch, gluten-free, and vegan granola. They rely on the power of simple ingredients: organic gluten-free rolled oats, pure PA maple syrup, organic unrefined cold-pressed coconut oil, and a variety of raw nuts and seeds. It is, well, the best ever. Find their original dark chocolate chia as well as seasonal offerings at over 90 retailers regionally. Best Ever Granola is not affiliated with LPL Financial or the Monteverdi Group.
All right, Ryan, we're back with the Tulip Bulb Market Bubble. I did it once pretty fast. That wasn't so bad.
That was good. Yeah.
It was good, right? I practiced while we were on break. The Tulip Bulb Market Bubble is often cited as one of the earliest recorded financial bubbles. Can you walk us through what happened during that time?
Certainly. For a little backstory, the Tulip Bulb Market Bubble occurred in the Dutch Republic during the early 19th century, a long time ago. Tulips had been recently introduced to Europe from the Ottoman Empire and quickly became a luxury item and a status symbol. By this, tulip prices had soared to extraordinary levels driven by speculative trading. So they're a status symbol. Everyone wants them. They're a luxury item. So let's get them shipped from the Ottoman Empire to the Dutch Republic. Let's get speculative and hoard these and try and make money based on everyone's desire for them.
Basic supply and demand. I think the humans are just so weird. I mean, because a lot of people, when you're alive in your own generation, you look at things and you go, "Oh, I can't believe our generation is so, focused on today, TikTok and Instagram and showing your best side and projecting that everything's perfect." But this is not new. This is the same thing. We got to have our tulips because we need to show everybody else how good we're doing and how look, we have tulips, you don't. You suck. And we're good. And it's the same thing. So this is when we talk about society today, this is nothing new. This has been going on forever. It's a human condition. Not the greatest part of the human condition, but it is the human condition. So back to the tulip bubble. What fueled this speculation?
Several factors actually contributed uh, tulips were relatively rare and difficult to cultivate, so that created a perception of exclusivity. They're hard to come by. Now, additionally, in this, I personally think was the bigger factor, a futures market, which allowed people to trade contracts for tulip bulbs at future dates. And I think on the show we've jumped into the futures market a little bit, but basically futures markets get created for, and originally it's farming basically, of if I'm a tulip grower and I'm doing this professionally, it costs me a lot of money up front before my tulips grow. I know nothing about tulip growth in cultivating them, so bear with me for a moment, but I've got to buy a bunch of dirt. I've got to buy a bunch of pots. I've got to buy the tulip seeds. I've got to plant them. I've got to water them. I've got to wait 6 months, and I'm making that up, 6 months before they grow and they're ready for me to sell them. How do I pay for all of that and get into it? The futures market is how you and I go into a contract where you say to me, you'll pay me today for a contract to buy, and I'll again just make up this example. You give me $100 today for the ability for me to deliver 100 tulips to you in 6 months. Now, you, as the buyer of that, are locking in your price. So it's costing you $1 per tulip. You have a risk there. If the market goes down, and in that 6-month time frame, now the price of tulips is 50 cents per tulip, you overpaid. Me as the seller of that, I have the same risk. If it goes up to $10 a tulip, I just missed out on $9 per tulip. And that negatively impacts me, but I need to have the resources to grow my tulips. So this is speculative trading right there. In this tulip tulip bubble, those speculative trades push prices even higher because people believe they could always sell at a profit. You didn't consider that there was any chance that it would be 50 cents per tulip once you took ownership. In your heart, your mind, it was guaranteed to sell for over $1 at the very least. You were going to make money. And you could also trade your contract. You can sell your contract to somebody else. You get $1 for it. In 2 months, you can sell that contract for $2. That creates this frenzy and creates the bubble.
And it's the classic bubble story. I mean, they're all the same because it was, for whatever reason, it starts small. If you get in early, you can probably do pretty well. But by the time it gets to the masses want to jump on the bandwagon when it's too late. And they're now artificially inflating because they're just dumping money into it. And we see this time and time again. We're going to continue to see it for a long time to come. And so in this case, what happened? How did that bubble end up bursting?
Well, this case was slightly different from a lot of the cases we talk about, purely from the standpoint that there wasn't fraud or deception involved.
That's nice.
With this bubble bursting. Yeah, it's a good thing. But what happened, the man disappeared. In February 1637, the market just collapsed. Prices plummeted as the buyers disappeared. People, they fell out of love with tulips, or there was too much supply. We don't have the demand anymore. It's not exclusive anymore because everyone jumped on board. And we see this in today's world, and primarily with fashion. Yeah. You see a new brand come out, and I don't care what the brand is, It comes out, it's exclusive, it's high priced. And then over time, once everybody wants it, next thing you know, you see, or we haven't seen it yet, but you're going to see eventually Lululemon being sold in Walmart. And I don't know when that'll happen, but that's basically the progression of what happens. They start and it's very limited, it's very rare, everybody wants it, price is very high. Then everyone copies it. Everyone jumps on board. And next thing you know, when there's too much supply in the market, the demand decreases and it gets cheaper. That's exactly what happened. Once that demand disappeared, it left many people with futures contracts for bulbs worth a fraction of what they paid. If you paid me $1 per tulip on that futures contract within that 6-month time frame, next thing you know, the 6 months expires and the going rate for tulips is 10 cents a tulip. You just lost your shirt. With all crashes, it caused significant financial losses and economic turmoil. Basically, as usual, the aftermath, it just highlights the dangers of those speculative bubbles and the importance of being rational, which I bring back to the bear and bull markets. It's the same thing. You should not speculate. You need to be rational and be smart in every move you make, not just jump all in because it sounds good and you've seen what happened in the past.
Yeah.
Every
And
bubble is this way.
every bubble is that way. And don't follow the herd, right? I mean, if you see the herd going, you're too late. And especially when you're talking about these exclusivity, when you're talking about brands. I mean, iPhone's done, or Apple's done pretty well with their iPhone. I mean, they've continued that. But there was a point where I remember people kind of talking about abandoning the iPhone because it was exclusive. Now everybody has one. So I want something that nobody else has. You can go through thousands of brands that went through this, but you have the exclusivity as everybody starts to own it. Well, you don't, the trend makers are now moving on to something else, and then the herd's following. If you can find that at the beginning, that's great. If you have that talent, wonderful. Follow that talent, but the vast majority are just following because we're not paying attention. Most people aren't paying attention. They got their job, their kids, their bills. We're crushed every day to try to analyze markets and specifically getting down to specific brands or companies is very difficult and time consuming. And if that's your job, that's a whole different story. And when you look to the markets or look to the media and they say Nike is really hot, whatever, it doesn't matter what brand it is, people start to jump on, and it's too late. You're probably buying where it's already elevated. Maybe you can get out with small profits or at least break even, but we've seen it time and time again where it doesn't have to be this massive bubble. It can be these little micro bubbles, and you can get hurt. So to your point, speculative investing is dangerous, to say the least.
It is, and I would argue with you relative to Apple. Yet people haven't gone away from the iPhone. Probably 10 years ago, I knew people like heavy Apple people. Every year when the new iPhone came out, you had to have it. You had to have the brand new one because it had all these updated features and it was the newest and best. And that was exclusive. You had people sitting in lines for countless hours to be able to buy that.
Sometimes, yeah, to get the new iPhone. It's crazy.
Yeah. Now and this isn't a knock on Apple, but the technology advanced so quickly, and now the new iPhone comes out. Well, what's the benefit of changing out? And you don't see those people waiting in line any longer to get the brand new ones. People still buy the brand new one every year, but just not on as large of a scale. People are looking at it when they have the release, and I get a couple extra megapixels in my camera. That's not worth spending an extra $1,000 on, or however much for the new one on it. So they have slowed down because I think a lot of it is because they're common anymore, and you can't really differentiate between newer models of them to say you've got something awesome, you've got something better than me. You don't need to keep up with the Joneses with iPhones any longer.
No, and they all look the
Yes,
same.
today.
Yeah, and that, yeah, to your point, the technological advances aren't these giant leaps, they're incremental advances. Over a 5-year period, you could say, okay, my 5-year-old iPhone versus the new one is quite a bit different. But year to year, yeah, I kind of just, I'm an iPhone user. It's every 3-ish years. I mean, whatever that contract I have with the carrier, that I get a new one every, I don't even know what it is, 36 months. But for me, it's even at that point, it's, does this one work fine? Once the battery starts to fail, and then but it's not because it's the newest features, because the features aren't that much different. And can you really tell the difference in camera quality between, so I don't even know what iPhone I have, to be honest. I think it's a 13, it might be a 14, it's not, I have no idea. And it doesn't matter. It's so it's interesting to watch that. And the Tulip Mania, as we said, it's just a classic example of how speculation can lead to disastrous consequences. And people, like we've been talking about, need to be very conscious of how they're investing. And at the end of the day, I really, unless you're a day trader type of person and you're doing that yourself, you need a plan, and figuring out what your goals are. You're not investing necessarily to try to pick the right stock at the right time. Most people need to be investing for a longer term goal, and that's going to change your whole investing behavior. And try to, instead of trying to get rich overnight from buying a stock, we say, okay, this is a long-term game. What are my goals? What am I trying to accomplish? That could be buying a house, that could be retirement, that could be college education for my children, a whole bunch of different things, but those are all goals. And when you're investing for goals, you're not trying to just win that one bet that you're making. I think that's important for people to understand. Thank you, Ryan, for looking at this, tulip bubble. And it's not really about the tulip bubble. It's just that mindset, I think, is really the importance of this mayhem segment, because a lot of the stories are similar. Some are unbelievable, but there's always a lesson to be learned there for today's investors, generally speaking. And so thanks for pointing that out.
Absolutely. You're absolutely right. The lesson is focus on your goals, not the FOMO, not the speculation, not the Bitcoin. Perfect example. Everything. Perfect example of let's not dive in.
Mm-hmm.
Let's set our goal to work together. That's the lesson in my mind, at least.
Yeah, and we're the shiny little things that are they're everywhere in our lives. It doesn't matter if it's investing. It doesn't matter if you're at Target. It doesn't matter if you're at wherever you're shopping. They always have the shiny things to get your attention. You're online. It's the shiny thing. Oh, I need one of those. It was I don't watch TV or regular TV where you have like QVC, but I was watching the news, or the Olympics was on. Every other commercial is this shiny thing. You have to have it. You got to have it. And part of you goes, oh, that's pretty cool. I should have one of those. And you're like, don't be a moron. You don't need any of that. Ignore the shiny things. Just stay focused as you can be on your goals. Forget everybody else. Put those blinders on and just move forward. That's all I have.
Couldn't agree more.
Yeah.
I love it. Wrap it up for us.
All right. Well, that's it for today. It's been fascinating, and I like that last segment was great. I think the bull and bear market was very informative. It's for people to know, again, very high level. Jim Rogers, amazing story. I love that adventurous spirit, and we all need more of that today, because I just feel like people have been so pushed down with what's going on in the countries and with work, and works now 24 hours a day. You don't have the time to get away, but you need to make the time to go have those adventures and go see the things and have those experiences. So that's all I have for today. So until next week, we look forward to talking to you again on Money Mavericks and Mayhem. And don't forget to subscribe, rate, and review our podcast. And again, join us next time for more fascinating stories and lessons. Until then, stay savvy, stay safe, and have fun.
Take care, everyone.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risks including possible loss of principal. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.